Welcome, everyone, to the Insurtech Insights webinar series, Navigating the Future of Cyber Insurance. Today, I'll be your host and moderator, Alexis Vaughn, founder and CEO of Off Course and best-selling author of Insurance Distribution of the Future. I am really excited because we're going to be talking about cyber today, and we have some phenomenal panelists who are going to be bringing in their insights and expertise to talk a little bit about what that future looks like for the cyber insurance market. We're going to cover a few different themes throughout this session. So as you have questions and as comments come up, please drop them in the Q&A, and we'll get to that at close to the end of this session. We're really excited to get started. So what I want to do first is make sure that you are actually fully aware of who our amazing panelists are. So we'll start with some panel intros. Stephen, we'll start with you.
Thanks, Alexis. Everybody, thanks for joining today as well. I'm Stephen Schwartz. I lead insurance at Safe Security. I've been with Safe coming up on 4 years. Most of my background comes from the world of large, complex commercial insurance, where I spent many years managing the insurance programs for companies paying at least $1 million a year in their annual P&C programs. The last decade plus deeply immersed at the intersection of how organizations quantify and manage cyber risk at the enterprise and bridging the otherwise disparate gap as to how that risk is ultimately transferred and underwritten via cyber insurance, which very much brings us here today. So I'm really excited to join the conversation. Thank you.
Thanks, Stephen. Jeff?
Hi, I'm Jeff Kolakowski. I run the cyber and professional liability platform for Westfield Specialty. I've got about 23 years of underwriting experience in all these lines, and I've been at Westfield now for about 4 years. So look forward to speaking with everyone.
Thank you, Jeff. And last but not least, Connor.
Thank you, Alexis. Connor Brennan. I am a underwriter at Arch Insurance based in Chicago. I've been at Arch now for about 9 years. I've been an underwriter for about 13 years. And in my role at Arch, I manage our central and west regions of underwriting teams.
Thank you so much, Connor. So let's get started. I really want to talk a little bit about what the global insurance, cyber insurance market looks like today. Right now, it's projected to reach $16.3 billion in gross premiums in 2025 alone. And this is based on a nice write-up from Munich Re. So to kick us off, let's set the tone. Guys, I want to start off with Jeff. What is the current state of the cyber insurance market post-2024?
Sure. Rates do continue to be under pressure overall and really in all revenue bands, the kind of SME, middle market, and large accounts. But they have been leveling out for the past few quarters. The reason behind the rate decreases really is new capacity and expanded risk appetite amongst carriers is driving rate downward. However, it's being countered a bit by increasing claims frequency and severity, particularly in the ransomware space, and we're starting to see more of an increase in system failure loss scenarios and the trickle-down effect of those.
Thanks, Jeff. Connor, what are your thoughts?
Yeah, just to piggyback off, Jeff kind of hit the nail on the head with the rate environment right now, and the claims activity has obviously been increasing. It has been, I think we're on our third year now of rate decreases, and they are starting to moderate a bit, but it has been, with a lot of new carriers in the space. And it's been a little disappointing from the underwriting side, to be honest. But, I think there's still a lot of areas for growth and areas to still remain profitable. But we'd hope to see some more underwriting discipline here in the coming year, especially, as well as a little bit of broker discipline too. I think there's been a lot of pressure on brokers to keep driving results, and that always hasn't led to the best outcomes for both sides of things.
Stephen, would love to hear your take on this as well.
Yeah, absolutely. I could not agree more with Jeff and Connor. I think they both hit the nail on the head. It's it's almost like we're this race to the bottom again, like pre-COVID, and we're doing it to ourselves. Even though we all talk about the decreasing rate environment and question as to why we keep doing it, hopefully we're starting to hit a plateau, and over within the next year we'll start to see rates increase, or at least get some more validation that we are pricing the risk more effectively. Because the last thing we want to avoid is that situation that we were in where everybody is hit with a 200% premium increase to cover the increased claims activity, because it just hasn't materialized yet. And we are headed into a world of unknown unknowns exponentially quicker than anything we've ever experienced before, which I think we lose sight of sometimes, when we're in our everyday, transactional underwriting, if you will.
That's a good point that you made, Stephen. I know that everyone's number one question is, are we headed toward market hardening again? So Jeff, I would love to kind of hear from you on this. What is the current state of rate conditions when it comes to cyber insurance?
So I would love to say we're moving towards a hardening market, but there's so much capacity, and to my earlier point, just this increased risk appetite. On the carrier side, you have a lot of boards are becoming more comfortable with cyber risk. On the client side, they're seeing the decreasing cost, and so that does create an avenue for increased coverage, increased lines and limits, which they should have because of the the evolution of a lot of these claims. But if you look at what caused the last hard market, it was volatility of claims. And, the disappointing part right now is the volatility of those claims is coming back. It's just in a different area. So I would venture to say that really from 2019 to kind of early 22, it was the middle market claims that were really driving a lot of concern, because you had lower retentions. These are smaller insureds. They were much less premium. And that kind of market got hit particularly hard by ransomware events. The past couple of years, it's been more in the large account space. So, where a lot of people thought that was a safe haven because of $1 to $5 million retentions on complex risks, those are coming down again, along with the prices. So we're not seeing that response, and maybe we just haven't had enough of it yet, which is not great to hear about on the carrier side. But I'd love to say, Alexis, and yes, it's hardening, and yes, we are going to see it in the next 3 months. I just can't say it right now because of all the other dynamics of just increased interest in trying to grow this product. And it's not just carriers, it's MGAs, it's others. It's a $16 billion market, you said, and everybody wants a piece of it. It's just up to the carriers to develop, and frankly, the brokers to really develop that long view of where they want to be at in not just 1 or 2 years, but 3, 5, 7, and 9 years, and create a sustainable marketplace. And I don't necessarily think we need to see a hard market like we saw a couple years ago. I just think we need to see stabilization, because just to make sure we have the rates right, that we have the coverage right, and all those factors.
Stephen, would love to hear you chime in here.
I think Jeff again is spot on, right? I think we all want to avoid coming back into a market where rates just harden exponentially. But there is a lot of volatility, right? We are still largely underwriting in a fog. When you look at, especially on the large enterprise space, trying to underwrite a 50 billion, 20, or even a $1 billion organization by typing their domain into some sort of scanning tool and a subjective questionnaire is tough. And interestingly enough, actually, and I see this, most of our customers at Safe are large enterprise Fortune 1000 entities. And I work very closely with them on their cyber insurance, given our partnerships and what we're doing here. And we talk a lot about this notion of inside out underwriting, getting objective telemetry, i.e. transparency for the underwriters to, have a more informed, data-driven perspective on a given risk. And I just share that in that it's, I've seen, it's been interesting when I see like a larger enterprise put together a 100 slide, renewal presentation, which is actually sharing so much more sensitive information than the notion of, like an API integration to their public cloud environment. And as an underwriter, like for Jeff or Connor, like that's a lot of information to try to disseminate, make sense of, and respond to in a quick way. And certainly when it's differentiated across every participant in the market. So it's I know it wasn't a direct answer because I couldn't have said it better than Jeff, and I think he nailed it there. But where I think there's some room for opportunity, and certainly where we're seeing some shifting dynamics, on our side. Now it's just sort of a matter of again, who's like taking the steps to be a leader, not just today and next year, but 3, 5, 7 years out from now.
Absolutely. Thank you for that, Stephen. I've heard a few people kind of mention how claims are also affecting what direction the market is heading into. So, Connor, can you talk a little bit about how short, medium, and even long tail claims even involve in cyber versus what traditional lines? And of course, keep in mind that we do have some non-cyber people, so they would love to know what short, medium, and long tail claims are.
Of course. I mean, I think we are blessed in the cyberspace because of the tail length. For a lot of our claims, it is going to be a relatively short tail. So we're able to make pretty quick reactions on, if it's a social engineering or even a ransomware claim, with the ransom payment being made, we're able to know pretty quickly, the dollar value of the claim amount versus some liability claims, which can go years, depending on how long the courts take. So within cyber, we do have medium and long tail claims as well. I mean, obviously for the any liability related matters, privacy related matters, and then also the business interruption type claims, just the amount of time taken to kind of determine the loss size in those as we've seen been very long in a lot of instances. So there is, we're still having to reserve and put up, that kind of timeline. But for the most part, we're able to make pretty quick decisions based on what we're seeing for the short term or short tail type claims.
Connor, just to add on to something that you said earlier about the business interruption, can you talk a little bit more about how business interruption losses are negotiated today, especially with that forensic involvement piece as well?
For sure. I mean, most, within most policies, there's some type of profit calculation wording. But that being said, we're hiring a forensic accountant. Usually the tower is hiring a forensic accountant within primary to kind of start negotiating that claim. That being said, then excess markets too are often hiring their own forensic accountant just to kind of double check the math. So that's kind of what leads to the kind of delayed processing of those BI type losses, because there is so many other cooks in the kitchen kind of determining the loss. So there is a lot of negotiation going on. I wish it was just a simple formula, but everyone's business is so different. And, there's going to be a lot of different assumptions being made on what constitutes the BI loss and what expenses maybe constitute the BI loss.
Perfect.
Go
ahead, Jeff.
Sorry. So if I could just say really quickly on top of what Connor was saying, it can be, on a smaller tower, it can be very quick and easy in terms of the short, medium tail claims because it's one or two parties that you're negotiating with. But on these larger complex towers, it can be a big point of contention, frankly, between carrier, broker, and client. And I just see this as a tremendous opportunity for the carriers and the brokers to work together to come to a better solution with these large national accounts, because we don't want to in any way disincentivize a client from purchasing this insurance. I speak a lot to our property brethren, and they've had 100+ years to iron out this process, and so we don't want to be fumbling around in the dark anymore, but it has to take a cooperative effort between the brokers and the carriers to figure out either, and it has to be pre-claim. It cannot be during the claim. So pre-claim, to agree upon either the utilization of a singular forensic accountant or an amalgamation of them, whatever it may be. But my big concern around the BI losses today is that it could just disincentivize clients from buying the coverage, because the process can take long. I mean, there's reasons on every side. On the carrier side, if you're a public company, you can't just cut a check willy-nilly without doing the research on it. And if that information's not being shared up the tower, it's forcing you to do that, to hire your own accountant. So there's got to be a way around this. And I think we need to address it now, during this kind of softening market, to kind of get rid of this issue before it becomes something much bigger.
Jeff, Connor, do you guys think in part this is an opportunity for where, depending on the scale and size of the end customers, where like a parametric sort of deductible buy down, that sits underneath your more traditional indemnity policy is some opportunity?
I do.
think so. Yeah.
Yeah. The complexity of parametric insurance, though, is going to be the hurdle.
Yes.
So there better be a really good white paper that explains it to each insured, because it took me a while to understand it as well.
Yeah.
I think the aversion too in this state of the market cycle is just, we can make investments for the insured. We can make investments in other areas right now, as well as just buying more limit, things like that, where the parametric is a very specific product that I think, like Jeff said, it takes a lot of understanding and buy-in from the insurer. So
Absolutely.
And it's still anyone on that side, right? And very focused on a singular type of event, right? It's like an if-then statement.
Mm-hmm. Yeah.
Mm-hmm.
So guys, let's talk a little bit about what claims trends you have been seeing. Of course, we always hear about ransomware, but what are some of the trends you've been seeing? And Stephen, I'll start with you and we'll hear from all the guys on this.
Yeah, look, certainly, Jeff and Connor are the ones who are actually, getting a bit more active insight day by day into claims, if you will. What we're seeing on our side, from our partnerships and, also just on the threat intelligence side, third party risk, is huge right now and will continue, and always has been, but will continue to be more prevalent, and something that we all need to get a better hold on, better transparency into, those single points of failure and accumulation risk. Social engineering, I firmly believe weakest humans will always be easier to exploit than technology. Especially now with generative AI. The amount of like spam invoices that I've gotten in the last 3 weeks has been crazy. Right. So I think we're going to continue to see an increase there. Whether it's ransomware or related, business interruption more broadly at, and regardless of size, but especially that, that BI and contingent BI exposure, again, coming back also to the third party risk is what we're seeing as some meaningful drivers right now.
Jeff?
Yeah, I agree. I would just add to what Stephen said, everybody's initial concern when it came to vendor reliance was Amazon. Everybody uses one big cloud vendor. What we're seeing more of, and particularly around the contingent BI, is industries where there's 2 to 4 major vendors supplying us. Yeah, it exists in healthcare. It exists in automotive sales. Like there's a couple of examples of claims and just instances where, there really aren't a lot of choices, and it's difficult to build a resiliency plan. You kind of have to contract with one or the other. And so a lot of our time is spent understanding, with our clients, what happens if that vendor fails? What is your resiliency? Like, do you have a backup internally? Is there a manual way to do things? We're having to dig very deep into these kind of dependency claims, because we've just seen that ripple effect. And it's not even from, these aren't traditionally ransomware generated either. It could be system failure generated. We saw a couple instances last year of security vendors and how a patch can just cause a ripple effect across airlines, logistics, transportation. And so on the underwriting side, we're spending a lot of time exploring that. And none of this stuff, and I think it was Connor, you mentioned this earlier, none of that's in an application. It really, and there is no standard application in these scenarios. And the benefit of working with larger firms is that they have that information to share, and they have a lot of those resiliencies built in. But when you get smaller, it's less and less the case. So it's just, we're trying to come up with what information we're trying to get to make us comfortable with these risks and their dependencies. And it's proven to be pretty difficult.
Jeff, you brought up. I'm sorry. I was just going to make one little statement, and where I think the notion of the cloud outage scenarios of like all of Amazon or all of Google going down. I think if that happens, we're probably all fighting each other for water, versus insurance claims. So it really is that it's that verticalization. Absolutely spot on.
Yeah, and I was just going to add too. I mean, when it comes to redundancies, like Jeff was saying, it very much comes down to, we need to be able to ask questions that aren't going to be listed on an application, and so it's insureds that are willing to have those conversations with us as the underwriters, as a market, are the ones that ultimately are going to be the most successful in getting favorable rates and favorable policy terms and hopefully favorable claims outcomes as well. Because, claims are inevitable, of course. We have numerous accounts where on paper, they look A+ and everything looks great. And, they have set up redundancies and all that, but claims do end up happening still. And it's the insureds that are willing to kind of work with us throughout the process that ultimately achieve the best outcomes. And it's the outcomes at the claims time. And it's also the outcomes at renewal as well. We're not going to cut and run from them, even if we just paid a large loss, a limit loss, if they're, willing to work with us and we're willing to work with them. And I think that's ultimately where our industry, the successful carriers are headed towards, is the ones that, are willing to work together. Everyone's willing to work together, and it's not an acrimonious relationship. So that's just kind of my perspective on it.
Guys, can you actually share with our audience how any insights that you have on how tower layering impacts business interruption claims? Connor, would you like to start that one off? And then
we kind of touched on it before. I mean, just in terms of the excess markets for these large losses, I mean, it kind of filters up the tower. So like Jeff was saying, if we can come, if we pre-claim, come to how we're going to kind of calculate this loss, who the firm's going to be used, it will likely be a less contentious, outcome as it's moving up the tower. But there's for a large publicly traded carrier, like Jeff said again, like we're still going to want to do our due diligence when it comes to calculating these BI losses. So, there's no perfect answer for that right now, but I think we're all trying to work towards that for sure.
Jeff, would you like to add?
Yeah. The only thing I would add to that is this is where I think this has to be a conversation with the broker and their client. So I don't necessarily know what the volume is the volume of carriers, and you don't see a lot of towers with 2.5 million layers. It's 5s, 10s, and every once in a while a 15 or something like that. But I really do think it's becoming increasingly important for our brokers and clients to understand the claims model of each carrier. Knowing their history, not even how long they've been in the space, but knowing the model and knowing the people to contact in these situations. And so I think that kind of carrier selection process is going to be more and more important as these evolve, simply because they have the experience doing this. And I'm not saying that new carriers don't have this, but you have to do the research into that and to really understand the mechanics of how claims work, who you're going to be working with, and kind of their philosophy on these claims. That should give knowing that should give the client and the broker a lot more comfort when you're facing these larger tower losses.
I think a lot of it comes back to the partnership, right? When I hear what Connor and Jeff are speaking towards, I think what a lot of us are trying to drive towards, you know, in the insurance industry here is that we want to partner with the end customers, right? We're not going to penalize you if you share, you know, some more transparency or not even necessarily more, but different data than you shared, you know, previously. We want to work together, and we're in this for the long term, right? And just even the importance, right, of that, of doing that, you know, actually testing your IR plan, business continuity plan, you know, that alone is millions of dollars saved in a potential event. Um, it couldn't agree more for whatever it's worth.
And I would just add to that too. A lot of us as carriers are offering like a BC or IR, you know, tabletop as part of your policy. So taking advantage of that too. I mean, it's low hanging fruit for the insureds to kind of receive the benefits of the policy that'll have positive outcomes on the back end as well, hopefully.
Guys, I want to go to the audience and answer one of our questions before we move on to our next theme of this session. The audience question is, how does cyber insurance respond to nation state-owned cyber attacks? Because many of these events can be linked to terrorism, especially in GovCon and larger accounts. Who would like to take that one?
I'll go.
All right, Jeff.
Yeah. It's a very good question. It's a very complex answer. But I think it starts with, you know, there's a challenge of OFAC in all of this. So, you know, if OFAC has identified a particular variant as a being sponsored by a nation state, or if it's just on the OFAC list, that adds a very big layer of complexity in terms of the ransomware payment, which is why a lot of the policies now are reimbursement versus pay on behalf of. But that being said, you know, keep in mind that the construct of the policy, it has a terrorism and war exclusion on there, typically with a carve back for cyber terrorism. But what's so unique about cyber policies is the trigger is the actual event, and not as much as where it may come from. It's very hard to discern really who, especially if it's a new variant, kind of who they're related to, or you know, who they're representing, whatever it may be. And so I would say, you know, if your trigger is a failure of security, if it is a ransomware attack, you know, that gets the policy moving. And so, you know, we've had to evolve the coverage along with these regulations, along with OFAC guidance and all that. And it really is meant to be there for that event, whether it be a system failure or whatever it may be. So, you know, I know it's not the best answer, and I can't give too specific of one because without knowing the actual scenario, it's difficult. But our brokers have done a very good job of making sure that anything but a completely illegal payment is really trying to be covered here, and that's what we're trying to do with the coverage. You know, we haven't grown this to a $16 billion industry with gotcha type exclusions. But this coverage has evolved so much over, I've been doing it for 23 years, and it's evolved so much to where it was just third party. Now it's first party. Now you've got the contingent BI aspects to it. So the coverage is going to continue to evolve as the broader kind of group of threat actors evolve their techniques, and as new claims come in. I mean, if I had known this coverage was going to be what it was 23 years ago, I might have switched to D&O. But it really, because this really, you know, it can be a catch-all to a degree. But I think the carriers and brokers have done a very good job of navigating through these, whether it be regulatory hurdles or just instances, to show the value of the product.
Perfect. Thank you for that, Jeff. So let's talk about our next theme. I want to talk a little bit about what embedded and all of the different evolving cyber products for SMBs are and beyond. Let's talk a little bit about how new delivery models for insurance and warranties are truly redefining distribution. So, and we'll talk about this as far as what the future of cyber insurance looks like. So I'll start with you, Stephen, on this question. How are embedded products solving for SMBs in this cyber insurance market?
Yeah, so a lot of what I'm seeing, and Right. So I spend, just for a little context, a lot of my time, or the majority, is probably spent on the enterprise side. With some of the work, with the work I do at Safe. Although recently, I've definitely, we've been seeing a lot more engagement on the SMB side, and particularly with, I would say, in a couple areas with MSSPs who are, working to incorporate a cyber insurance as part of their value prop. I still think there's a bit more that needs to be figured out, if you will, strategically, and how to actually drive that adoption effectively. Right. Ultimately, regardless of who the channel is, insurance is a product that is sold. Right. It's not bought. People don't wake up on Sunday like, let's go buy insurance today. That sounds fun. Right. So we need to keep that in mind, and that's and also that, companies' cyber insurance policy, especially on the SMB side, 90% chance it renews with the rest of their insurance policies, which is managed by their insurance broker. Right. So we just need to keep that in mind when we look at some of the new non-insurance led distribution channels and approaches. That being said, where I think there's a lot of interesting innovation, and again, where we're still really in early days, is as it relates to the new cyber warranties that are coming to market. Providing some degree of cover, like actual coverage, not a warranty, just as another arrow in the sales quiver. But where, right, if there's a device failure of sorts for your EDR, right, or your intrusion detection, your firewall, that there is a very quick quick payout, which can be aligned with your actual cyber insurance policy. So I think what we're seeing there come to market is really unique. And very interested to see what it's going to look like 2-3 years from now, as we continue to get, I would say better data, on the actual insights and risk across these small businesses, and the appropriate structures and partnerships in place between those MSSPs or non-insurance intermediaries with the insurance industry. The last thing I'd say too is, I've actually also seen recently sort of a reemergence on the personal cyber side. I think when some of the solutions initially came to market, we were there before the market really existed. Where now there's a bit more. Cyber risk has hit all of us as individuals in some capacity at some point, and where the rise of smart homes is creating unique risk and also unique opportunity now, with a different distribution channel that's not your telco, where you're trying to embed a $400 policy next to a $30 a month phone bill. Right. But where that's embedded, when when a smart home integrator is actually, installing your network switch, your firewall, your security cameras, so on and so forth within the actual home. So seeing quite a few unique solutions start to come to market in this regard.
Connor, Jeff, you want to add anything as far as the embedded products and even warranties, how they're actually becoming are you seeing them become more of a core part of the cyber coverage strategy today?
Not for myself, not really, to be honest. I mean, where we're playing, they're not really a big part. I will say the personal insurance side of things. I mean, we have started to see like key employee type coverage extended to, C-suites, executives, things like that. But as a standalone product, I haven't seen much uptick in that.
Actually, yeah. Jeff would love to hear from you. But before we move to that, Connor, talk a little bit about, have you actually seen that there's a meaningful market for the personal cyber there as well, since you've been seeing more of that?
No, not really. I mean, me personally, no, I haven't. So
Okay.
I think maybe in the future there would be, especially with privacy and things like that. But I think, we're a long ways off from that. And it's, it
It's
just,
an
just like
ultra
the
high
other,
net worth risk,
exactly.
maybe.
That's where I would more see it being prevalent. But I think just like the evolution of our product as the more corporate side of things, it'll take time on the personal side as well.
Yeah. Jeff, any thoughts to add around the embedded warranties or even personal cyber?
Sure. Yeah, with the embedded warranties, let me just say that I know, that is the biggest growing market in our space, because I'm not going to pretend I know the statistics here, but I do know a large percentage of SMBs don't buy cyber. And so people see that as a great market opportunity. That being said, it's got to be very confusing for an SMB who may not have a dedicated IT group. They may outsource everything, or may have, their IT person that does both security and laptop startups. So, it's a very tough market to see what you should actually buy. The warranties are a really interesting evolution because they're providing effectively a gap filler coverage for particular areas where a cyber policy might not cover, or maybe a bit of a gray area on, but they're a gap filler. So I wouldn't want to just rely upon a warranty as my cyber protection, because typically those warranties are tied to a specific product or service. So it may give you full coverage if your vendor goes down, or if your security software fails and you get hit. But if you have a cyber attack that wasn't really caused by that, then you're left without coverage. So I think it's a great complementary coverage, and it's something that our SMBs should be pushing their vendors for. But I don't know that it's necessarily a good replacement for the cyber coverage. With regards to personal cyber, this is not really my area of expertise, but I do know, certainly within the high net worth space, it's becoming a more popular product as a rider to their overall kind of package policy. But we have. It's interesting with the personal products because they're very inexpensive, and you just really have to understand, and it's difficult for somebody not having experience in the space, understanding that breadth and cover. So that's where I think it really does go on to your personal lines agent to really explain the breadth and cover of the particular product, because even though it may only be $38, it could be $38 down the drain if you don't understand what it actually does. So I think, I
If
think
it's like
everybody,
LifeLock, it's $38 down the drain.
I mean, look, everybody on this call, and I'm sure all of our audience has gotten some type of text or call about a loan that's almost close to completion. They just need you to call back and do this, or your Google or your Gmail is full of spam emails, is begging for you to click on it. So, I just don't know the breadth of those products to say that yes, you should buy it. But I do think it is a quickly evolving marketplace. Just because of what we experience on the personal side. I mean, I'm sure everybody here has had to file either a police report because of a stolen credit card or their identity being taken. And it's just such a pain in the butt. It really is a nightmare to navigate through, because that one event can affect your mortgage application. It can affect your credit score, and they can be fixed, but it's really it's a nightmare scenario from a personal standpoint, because it's such a disruption and it just seems so unfair. But you can't. It's very difficult to fight without some type of coverage backing you up.
Absolutely. So I know that a lot of the distribution channels are definitely shifting. So, and I, even in regards to what the MGA playbook used to look like, even during my days as an MGA owner versus what an Insurtech MGA playbook looks like today. I would love to hear from Stephen, what does that Insurtech MGA playbook look like now, specifically in the cyber insurance space?
That's a very, very interesting question. So it's I think if we take a step back and just look at the evolution of the InsurTech MGAs, there's a lot of great things for us to take away. and some not so great things to take away as well. I'm glad that the broader macro environment has recognized that we shouldn't value these companies with a revenue multiple on gross written premium, as that is not their premium, as that is not their revenue. I'm sorry. But coming back more directly to the question, I think for a while we started to see a lot of solutions that felt like it was just skinning the cat slightly a different way. I think like Coalition personally has put themselves in a different league, their own relative to the other Insurtech MGAs. When you just look at their scale and size, and how they're moving across other lines of business and whatnot. When we think of like the newer MGAs that have also come to market more recently in the last year or so, I'm seeing a bit more focus. I think say the original initial cohort, right? Coalition, Cowbell, At Bay, Corvus. I almost have a sense that they were a bit more focused on like the distribution technology as the starting point, and
That's
then building
correct.
in the different security capabilities.
Absolutely.
Where now I think we're seeing more solutions that definitely like without distribution you don't have a product. So
Correct.
you can't lose sight of that. Right, but how can we take a look at the risk a bit differently? When you change the way you look at things you look at change. Right, so where I'm just seeing a few different like underwriting methods and how that data is being captured. With some of the newer like SMB MGAs. And I think too, it's also what we need to learn and bring back to the traditional larger incumbents. Again, a lot of my work, right, is partnering with the likes of Connor and Jeff on larger mid-market to enterprise type of risks. There's a lot that we can learn, as the more traditional players in the market, and benefit from that the insurtechs have introduced. And candidly, I think there's a greater opportunity, when you look at the partnership between insurer and, a third party trusted security company that has a much different degree of trust from the end customer than the security solution that is offered and built by an insurtech company. That only works for a customer up to a certain size and sophistication. So I sort of danced around like a politician there a little bit, Alexis. I'm sorry, but hopefully gave some context that Jeff and Connor might agree with and can expand on.
You did well. You did well. Listen, I agree. I agree with a lot of what you said. Guys, would you like to add anything?
I would just add look, I think the insurtechs really were a fantastic part of the value chain over the past couple of years, and I love that they actually push traditional carriers to look at risk differently and look at their distribution differently. It's not this sounds really lame, but insurance and innovation don't rhyme, and so I think the insurtechs forced everybody to innovate, whether it's their underwriting practices, their service model, how they distribute their policies, and I think that's all a really good thing. But if you're looking at it from a client view, I would just stress a point that I hit on earlier. Don't just look at the kind of benefits and add-ons of like, oh, we'll guide you through this, we'll do this. Understand the claims model, because the almost all of the insurtechs have a different claim model than a traditional carrier that has a couple more steps in it. You've got the TPA functionality built in there where there's a $25,000, $100,000, $250,000 claim threshold that they have to go to before they have to cooperate with their sponsoring carriers in paying out a claim. And that can be challenging sometimes, and it really depends on the revenue band customer that they're servicing as well. So a lot of these insurtechs have gotten to that 6-7 year point and made a lot of changes, and I think for the good. But what's interesting is a lot of the naysayers in 2017 and 2018 were like, this model's going to go away. It's like the ILS space and whatever. No, it's here to stay, and they've proven their worth definitively in the SMB space, and are trying to in other areas. But again, it's up to the broker and the client to ascertain why an Insurtech model is different, and do they have a comfort with that? And if they do, great. If not, then that just means you have to have a different criteria for carrier selection.
Absolutely. You know, one of the things I want to add that I think Insurtech MGAs have been really great at is doing more than offering a policy and being reactive. They have taken this proactive risk management approach and also giving clients exactly what they're looking for, which is more than an insurance policy, where it also has these value add tools in there, education, risk management, things like that. And especially when we're dealing with the newer generations who will be buying in insurance, we have to find ways to make it more attractive to them as well, even outside of the embedded process. So I think that's something that a lot of the traditional carriers, I'm starting to see more of them kind of take that on, either partner with an Insurtech or actually end up just in creating something internally where they can have that value add there in every area of insurance and not just in cyber, for sure.
And that's where we need the brokers, Alexis.
Yes.
Right. Without the brokers, we can, Connor and Jeff could come up with the best solution, value added service in the world, but the broker's the conduit to the end customer ultimately. Right. So we need to, think about how can we keep them incentivized to at least bring up the conversation. Like I've seen so many times where just the brokers haven't communicated the value added services that are provided from the carriers, and and there's tangible, meaningful value there.
Yep. And a lot of that goes to them not understanding all of the different things, especially when technology is added in there. Some things you have to activate so that you can get access to a discount or to additional services. So I think it's also the Insurtechs, whoever is running the distribution, actually focusing on educating those brokers and agents about all their different solutions and positioning them well in the market as well.
And I think that's something where we could all do a better job of just explaining the value added services and, driving the uptick and the take up rate in those. And like you said, Alexis, I think the Insurtechs did a really good job of starting to make those very front of mind. And so as legacy carriers, we've all now kind of tried to follow up with that and push our own, using third parties and stuff, and even developing tools in-house as well. But I think that has proliferated throughout the legacy carriers now as well. And it has just become now it's educating the brokers and brokers taking the time to learn everyone's capabilities there and then pushing their own clients to use them.
Absolutely. Absolutely. I want to take one audience question before we move on to our next theme of the session. Let's see. We will take this question. With removing government funding on CVEs, how will insurance companies change their approach assessing risk?
We've got one more year, so
yeah, one more year.
We got a lot of months to figure this out. Come on.
Ask that question in like 10 months from now, and then we'll have a better.
Yeah, I would only answer that with please don't remove funding for that. That is to worldwide benefit. And so if this ends up being more of an effort to get others to contribute, great. But this is a database that everyone uses, and it helps us, our clients, and frankly everybody in the value chain just be more aware of developing risk and of the current landscape on a daily basis of issues. So please don't defund that.
And I think
it does probably. Go for it.
I was just going to say, if anything positive were to come out of this last week or so, is just it kind of brought to light the importance of the database and how underfunded. And, I think we were all kind of in shock that it was just kind of like all of a sudden it's on the chopping block. And so hopefully it kind of stays in the limelight now and it gets proper funding. And if anything, gets more funding, more congressional involvement with it. So I think it was kind of a positive that came out of that.
Yeah, it kind of, to Connor's point, it kind of calls out the need, certainly for us as the insurance industry, because look, at the end of the day, we're the only ones who actually get the data right on the claims, right? We know what
Yeah.
claims cost and the drivers of those. It's potentially a wake up call, right, for us to make sure we don't lose sight of the different initiatives where we are trying to share data between public, private, entities and organizations. That would have, if we didn't get that 11-month runway, that would have been a night. I don't know if we would have had this webinar this morning because how much we'd all be scrambling around.
Absolutely. So, guys, let's shift into the future and talk a little bit about AI, automation, and emerging risk categories. Specifically, let's kind of start off with what are some of the dangers that you're seeing when it comes to deep fake technology and even AI generated social engineering attacks? And we'll start with you, Connor, on this one.
Yeah, I think, the first thing that comes to mind with kind of the risks of AI and deepfakes is obviously the low-hanging fruit of social engineering, trying to get payments made or a wire transfer made to you quickly or something like that. But we've kind of seen the evolution of that turn into, phishing campaigns to kind of obtain credentials, admin credentials, and then obtaining those credentials, moving laterally, and then, deploying ransomware or exfiltrating data or something like that. So, I think it's AI is obviously evolving very quickly and rapidly, and it's gotten extremely hard to tell what's real and what's not real. So just having the proper checks and balances in place, just like you would if it was any criminal, calling on you, if you're calling on a help desk, verifying who's calling. But it's tricky right now, and I think it's something that we're all as a society grasping with, and there's no good answer to how to kind of combat that outside of, like I said, trust and verify.
Mm-hmm. Absolutely. Jeff, should there actually be a standalone AI coverage, or is it kind of already implicitly covered in most forms?
If it's part of a company's service model, it should be covered. There's two aspects to a lot of these policies because a lot of the forms are blended with an E&O component. So, you've got across most forms and most carriers, there is that embedded coverage if it's part of a service model. And very few carriers are excluding AI. As a standalone product, Alexis, I've been asked that question a lot. I don't even know where to start, frankly, because
We don't know enough yet.
Yeah, you've got the regulatory issue, which there is none in the U.S. right now, and there's some developing in Europe. But I don't know that it needs to be. We're always trying to find new products, but I don't know that it needs to be right now, because if it's part of your service model, if it's embedded within your technology infrastructure, it's kind of hard to see how that could be excluded. But that also depends on a lot of the pending regulation that's out there right now. Nothing's been stated yet in the U.S., but as that develops, we could look at the policy and say, wow, this is way too broad, or there's no coverage for this, so we have to modify. So I think we have to wait and see a little bit, but in current state, I would assume it's really embedded.
Yeah, there is at least one standalone AI insurer in the Insurtech MGA space today that exists. I still wonder if there is space for others, maybe a little bit further down the line, like you said as well, Jeff. So that's good to know. So I do want to ask specifically, Stephen, are you seeing more carriers moving toward the inside out underwriting with customer shared information?
Yeah, Alexis, and obviously I'm biased here, but speaking objectively, I will say it's really picked up in the last 6 months, 6 to 9 months, and which is interesting because it's picked up amidst a softening market. And look, the key has been alongside getting the carrier adoption is the broker adoption, right? If we don't have the brokers trained, able to communicate the message to the end customers, as to what this new process is, right? The value of it, irregardless of any insurance incentives. And for those, in the crowd, very quickly, what we're talking about here is the notion of, integrating via API to an organization's public cloud, their CrowdStrike, their vulnerability management solution, right? To have a much more informed, transparent view of the risk when underwriting, and for customers who are willing to do so and share that, rewarding them with unique policy incentives, i.e., premium discounts, anywhere from 5 to 30%. Right. So we now have, and I know Safe isn't alone in this, but Mosaic, Chubb, Zurich, Liberty Mutual, several others that I can't name at the moment, who have already, started to take steps here and introduce this, more broadly, as well as on the brokerage side. I think the industry would be surprised as to the uptake. Customers are not pushing back nearly as much as we thought, or certainly 2-3 years ago. And a lot of that comes back to the messaging, right? If they know that there's no penalty in it for them, that the worst case scenario, they decide that they don't want to share this data with their carrier, right? But on the that if they could get a 5% discount regardless of the output, coming back to the notion that we want to partner together over the long term is really a big, it goes a long way and makes a big difference. And the efficiency gains from it. Look, on the large mid market and enterprise side, it's it could be a death by paper cuts, very tedious renewal process where in less than an hour, you could do a couple API integrations and have a much more insight and visibility across your risk posture, and an ability to potentially automate those applications. So we're seeing a lot more adoption, and when we look at the efficiency gains and the policy incentives, and now we're seeing a lot more inbound engagement from carriers. Right, as we're basically I'm trying to build that $100 million tower, if you will, of inside out underwriting. So, Jeff, Connor, we got to talk.
I would add too. I think it brings a lot of value just in terms of the partnership between the carrier and the client themselves. I mean, I think we've seen the shift of with some of these inside out or outside in type scanning. That kind of extends the renewal process throughout the year versus just, a static once a year, which is in this line of coverage is very beneficial. We're a partner with you. We're not looking to change rates or anything throughout the year, but if we can provide value with catching things that you might not have caught yourself and potentially prevent a claim, there's a lot of value there. And I think that's what ultimately, even if we're not giving you a discount in premium, which ideally, that is what we'd be giving you with an integration like this. There is that second set of eyes that we are providing then with our risk engineering team that is very much a benefit, and it's showed benefits even at the enterprise level for us. So it's pretty interesting.
Yeah, I would just add
the
biggest component of that is the model exists, right? It certainly does, and I'm going to reference property again. There's audits 1-2 times a year, maybe more, consistent updating of locations and TIV and things like that. The issue on cyber is that the data is a lot more sensitive. It's not an address. It's very sensitive data, but as an underwriter, it's a big gamble that we take in looking at an insured's controls, security posture, business model, everything on April 1st, and then kind of crossing our fingers for a year and seeing how it evolves. The change in even just the infrastructure of our insureds can be dynamic within only a 3-month period. So it really does make sense. It's just we have to get our insureds and brokers comfortable with that data exchange component, to both Connor and Stephen's point.
Got it. Guys, as we move to our final theme, I want to ask one question for you all. And if you all could give an answer, that would be great. What are some of the sectors, when it comes to regulatory and sector-specific risks? What are some of the sectors that are becoming more vulnerable beyond the finance and healthcare? And Connor, we'll start with you.
Professional services firms, I think historically have been kind of one that we didn't think there was as much exposure to. And now, I mean, when they're handling lots of data, of course, that's always going to be an exposure, but we've seen definitely an uptick in ransomware claims in the professional services space. And I would throw in manufacturing and distribution networks as well.
Perfect. Jeff, would you like to add?
I mean, Connor stole my answer, but if I had to add one to it, it's not a new one, but I really, the public entity space continues to be a very, very difficult spot because it's difficult to insure in that you look at the dynamic of a public entity, there's constantly shifting management or elected officials coming in. So it's hard to have a consistent kind of philosophy of how they control their risk and how they manage their security platform. There's a funding issue, all these things. And the coverage is much more expensive for them because of just the control atmosphere. And so it seems to be, it's not a new risk frontier, but I feel like it's a problem that the industry and frankly, both brokers and carriers have still not really addressed. But it's probably the sector most in need of a consistent offering there. There's just so many different issues that prevent us from doing so.
Stephen, anything you like to add?
Well, Connor and Jeff likewise took what I would have initially spoke to. So I will just extend on the manufacturing side and like companies with industrial operational technology. I think there's a lot of opportunity for us as an industry to provide some more meaningful cover, and also just the data that we can start to capture to understand that risk in a more meaningful way. Also, when I think of just some unique opportunity, when you look at, on the other side of the question here, like, when you think of like some of these large wrap up, CSIP, OSIP, contractor programs for whatever large construction project, and you've got 10, 15,000 subcontractors that are working with, said contractors on various projects throughout the year. None of them have cyber insurance today. Right. Like just great opportunity where I think if you want to call it affinity group, I don't know if that is the appropriate nomenclature here, but where I think, the right sort of program opportunities with the right partners in those pockets is a great opportunity for the market. And yeah, I'll sort of leave it at that.
Perfect. Well, gentlemen, we are out of time. I want to thank you so much for sharing your cyber expertise with our audience today. Stephen, Connor, Jeff, I'm sure that our audience got a ton out of today's session. And definitely connect with all of these guys on LinkedIn to be able to keep up with them, the work that they're doing in the cyber insurance landscape, and then be able to get more insights like these. Again, thank you guys so much for attending. I'm your host and moderator for today, Alexis Vaughn, founder and CEO of Off Course and best-selling author of Insurance Distribution of the Future. Thank you for joining us for your webinar today with Insurtech Insights, Navigating the Future of Cyber Insurance. Have a good day, everybody.
Great.
Thank you.